Well, we all know the VIX is a measure of investor equity fear, and what a useful little index it is. It's something that I pay a lot of attention to when trying to time reversals. So whenever the VIX or investor fear gets really extreme, such as it has the last 4 or 5 times, it's a real indication that equity bears probably ought to move out of the market because those extremes, by their very nature, make the market very exposed to reversals. Same thing on the bottom of the market. So, when we look at the VIX, it's a great way to get a little bit of insight into what traders or equity traders think about the risk out there in equities. When the VIX is on the rise, it means they're getting really concerned about what's going on in equities, and because the market is inverse to that, so the stock market responds very negatively to that. The stock market will actually decline while the VIX is inclining, and conversely, the stock market will go up when the VIX is falling, such as it has here very recently. So over the past couple of months, the VIX has been in decline. Fear has been in decline. That means that the market is, traders are getting an appetite for risk back, and they're driving equity prices up. So a pretty straightforward relationship, and one of these things that when it gives these periodic signals that there's an end to a particular trend, time to pay attention. And this is not only useful for equity traders, but even bond traders, currency traders. Everybody is concerned about what are investor attitudes about risk. And one of the great thermometers of investor appetite for risk is the VIX, because if traders are in the mood for high risk assets like stocks, then that means that they're going to be in the mood for things like a short yen position, for example, in the currency market, or they're going to be less inclined to buy government bonds, which are very low risk. They're going to be looking for higher yields. So we can infer a lot of information from this particular index. So very useful. Now you may be thinking, well, gosh, if it's this useful for equities and there's no secret behind the formula, it's just a measure of implied volatility of the options on the SPX. Why couldn't you do the same thing for other markets? Well, you can, and I think it's particularly relevant to have this discussion right now, as the traders, investors, the press, everybody is really focused on oil. Well, what about oil volatility? What about oil? What about fear surrounding oil prices? Well, there is actually a volatility index, just like the VIX, it's the oil VIX, that measures the same kinds of things. Let's take a look at that, and we'll walk through what it means and how we can use it. Now, this is the oil VIX. Now, it's a little bit different than what you're used to. Now, you can or you should be able to pull this up in most charting applications. You shouldn't have to have an institutional grade package, but it may not appear in every charting application. The symbol is OVX, and it works similarly to the VIX. In other words, it goes up when investor fear is going up or is on the rise, and it goes down when investor fear is going down. But what does that mean for oil prices? If traders are getting fearful, what is that going to do to oil prices? Well, it's going to drive them up, not down. So traders start to add a risk premium into oil prices when they become fearful of volatility. And conversely, they take that they start to discount oil prices when they become less fearful. So you'll actually, unlike the VIX, which is the inverse of the equity market, the oil VIX is actually correlated to the oil market. So over the past year, as you can see, the oil VIX has been going up at the same time that oil has been going up, and recently has been in decline at the same time that oil has been in decline. Now, like the VIX, however, a study of support and resistance can be very effective. So we're going to connect the first two dots here. It's a very new index. We're basically at the max of how far it goes back historically. We're going to connect the dots between the first two major peaks, and we're just going to extend that out so we can get a sense for, just like the VIX, what kind of a channel does this index operate in? Because every time it starts bumping up against this channel, such as it did again in March, in June, and even here recently in July, what is that telling us? It's telling us that investor fear is reaching an extreme. What does that tell us about oil prices? It means that traders are probably going to start pulling that risk premium out, and discounting prices, oil prices are likely to fall. We can make the same kind of an analysis by connecting the dots along the bottom of the oil VIX as well. We can see, well, how close are we to coming up against the bottom? So I'm connecting the dots between the first two major bottoms. This is going to connect us with where the market really, where we first got a real support bounce here in May. And we're approaching that level right now. In fact, we're very close to that level. So this raises a big question mark. All right, so we're within this channel of fear and concern in the market, where fear has been in decline, but we're approaching the bottom side of this channel that has been in play for over the last year. From a investor sentiment perspective, this means that we have a certain probability that oil prices may in fact rebound as risk, or as fear of that risk begins to rebound and head back up towards the top of this channel. So I've shifted charts here just a little bit, and you can see I've identified those same periods here where the market got to extremes in fear, and you can see that that coincided with two small tops, one here in March and another one here in June, and then a major top in July. So when we get the oil VIX bumping up against the top of that channel that was established earlier, we get a very high likelihood for a correction. This is a good opportunity for traders relying on higher oil prices. So whether that means you're trading commodity currencies long, or whether you're trading oil long, or whether you're trading oil stocks long, or whether you are just trading the stock market long, and you're looking for a nice new opportunity to get in when oil won't be sucking so much enthusiasm away from equity traders. These are good signals. Now, I've also plotted that first legitimate bounce off of the channel to the downside, and we are there again on oil. Now, not coincidentally, by the way, you'll notice that we're sitting basically at a support level. So if we think about the basics of support and resistance, we know that these three major inflection points, 2 times the oil VIX has indicated a shift in sentiment, and the market has transitioned. Previous resistance becomes current support, becomes question mark. So the takeaway here is, what are we expecting in the future on oil prices? The implications go across the capital markets. We don't have to be an oil trader to take advantage of this kind of an analysis. If oil prices in fact do bounce, it's going to be bad for equities. It's probably going to be good for bonds. It'll be good for commodity currencies. It's likely to be very bad for the U.S. dollar. So these are all conclusions that we can start to draw, and we have a big red flashing light in front of us that says imminent inflection point in the market, meaning that the investor fear as far as oil has started to come down. From a technical perspective, that indicates that there is the possibility of a bounce back up in investor fear. That means the premium goes back into oil prices. Oil prices start going up. Now, we don't know whether it's going to happen or not. Nothing is 100%. But it's certainly one more tool we can start to look at to try to get a perspective of not just what are oil prices doing, but what do investors think about those oil prices. The oil VIX is a great way to get that kind of insight.